Hi everyone, this is Tao Chai um, at the University Library right now. So I'm sorry if you guys hear students in the background. Okay, so we are going to be looking at journalizing the transaction, right? This is going to be part two of the analyzing business transaction. This is going to be debits and credits, okay? Okay, so let's start off with a little inspiration. By Nora Roberts. So if you don't go after what you want, you'll never have it. If you don't ask, the answer's always no. If you don't step forward, you'll always stay in the same place. Okay, so an account is an individual accounting record of increase and decrease in a specific asset. So liabilities, stockholders' equities, revenues or expense item. In the simplest form, an account consists of three parts. Um, One, the title of an account, a left or debit side, and a right or credit side. So because the alignment of these parts of an account resembles the letter T, it is referred to as a T account. So debits and credits, right? So the term debit identifies the left side of the account and the credit identifies the right side. They're commonly abbreviated as DR for debit and CR for credit. So they do not mean increase or decrease. As in commonly thought, we use the term debit and credit repeatedly in the recording process to describe where entries are made in the accounts. So, for example, the act of entering an amount on the left side of an account is called debiting the account, and making an entry on the right side is crediting the account. So, when comparing the total of the two sides, an account shows a debit balance if the total of the debit amount exceeds the credit. An account shows a credit balance if the credit amount exceeds the debit. Okay, so every positive item in the tubular summary represents a receipt cash. All right, so the tubular summary, you guys are looking right here. Um, every negative amount represents a payment of cash. So notice that in the account form, we received the increase in cash as a debit and a decrease in cash as a credit. So that's the account form. That's what we're going to be using, right? The account form. So for example, the $10,000 receipt of cash in blue is a debit for cash, and the $5,000 payment of cash in red is a credit to cash. So having an increase on one side and a decrease on the other reduce recording errors and help determine the total of each side of the account as well as the account balance. The balance is determined by netting the two sides, subtracting one amount from the other. So the account balance and debit of 1502 identifies, like 1502 identifies the company had 15,200 more increase than decrease in cash. That is, since it starts with a balance of zero, it has 15,200 in cash account. Okay, so debits and credit procedures. So each transaction must affect two or more accounts to keep the basic accounting equation in balance. So in other words, for each transaction, debit must equal credit. The equality um, of debits and credits provide the basis for the double entry accounting system. So under the double entry system, the two side effects of the transaction is recorded in the appropriate account. So this system provides a logical method for recording transaction. The double entry system also helps to ensure the accuracy of the records amounts and helps to detect errors. If every transaction is recorded with equal debits and credits, the sum of all the debits to the account must equal the sum of all the credits. The double entry system for determining the to determine the equality of the accounting equation is much more efficient than the plus and minus as we saw earlier. Okay, so DR/CR procedures for asset and liabilities, right? So in the last slide, increase in cash and asset are entered on the left side, and a decrease in cash are entered on the right side. So we know that both sides of the basic equation, asset equals liability plus stockholders' equity plus B equal. It therefore follows the increase and decrease in liabilities have to be recorded opposite from increase and decrease in the assets. So thus increase in liabilities are entered on the right or credit side, and decrease in liabilities are entered on the left or the debit side. Okay, so right here, asset accounts normally shows debit balance. That is, debit to specific asset account should exceed credit to that account. And then likewise, liability account normal size credit balance. This is credit to liability account should exceed debit to that account, right? So knowing which is the normal size and account in the account may help when you're trying to identify errors. So this is very important. So you always want to know which is the normal balance side on the asset, which is the debit, and the normal balance side for liability, which is the credit. Okay, so for example, if the credit balance in the asset account, such as land or debit balance in liability accounts, such as salaries and wages payable, usually identifies errors in recording. So occasionally, however, an abnormal balance may be correct. The cash account, for example, will have a credit balance while a company has overdrawn its bank balance by spending more than it has in its account. In automated accounting system, the computer program usually flags a violation of the normal balance and prints out the error or the exception report. So, but in a manual system, careful visual inspections of the account is required to detect balance problems. So be aware of that. All right, so the DR/CR procedure for stockholders' equity. Okay, so we call the stockholders' equity is comprised of two parts, right? So common stock and retained earnings. So revenues, expense, and payments of dividends affect retained earnings. Okay, so therefore the subdivision of stockholder equities are common stock, retained earnings, dividends, revenues, and expense. And then common stock, right? So common stock is issued to investor in exchange for stockholders' investments. The common stocks accounts is increased by credits and decreased by debits. For example, when cash is invested in the business, cash is debit and common stock is credited. Okay, so retained earnings. Retained earnings is net income that is retained in the business. It represents the portion of the stockholders' equity that has been accumulated through the profitable operations of the company. Retained earning is increased by credit, right? For example, by net income, and decreased by debt, for example, by net loss, right? So that's retained earnings right there. Then dividends, right? Dividends is a distribution by a corporation to its stockholders. The most common for distribution is cash dividends. Dividends result in a reductions of stockholders' claim on retained earnings. Because dividends reduce stockholders' equity, it increases dividends accounts are recorded with debit. Okay, right here, so we're going to be looking at revenues and expense. When company recognized revenue, stockholders' equities increase. Revenues accounts are increased by credit and decreased by debit. Um, so expense decrease stockholders' equity. Thus expense accounts are increased by debits and decreased by credits. So credits to revenues account should exceed debits, and then debits to expense account should exceed credit. So take a look at that where the normal balance is at. Thus revenue accounts normally shows credit balance. Expense accounts normally shows debit balance. Okay. All right. Stockholders' equities relation. All right. So this is the relationship Companies report their sub-dividends of stockholders' equities in various places in the financial reports, right? So common stocks and retained earnings in the stockholders' equity section of the balance sheet. Dividends on the retained earnings statement. Revenues and expense on the income statement, right? So dividends, revenues, and expense are eventually transferred to retained earnings at the end of the period. As a result, a change in any one of these three items affects the stockholders' equity. All right, so we're going to look at income statement. Income statement is going to be revenue minus expense, gives us net income or losses. That goes into the retained earnings statements, right? So the retained earnings is going to have the beginning retained earnings plus net income minus dividends, and then that will give us the retained earnings. The ending retained earnings. The ending retained earnings is going to go to the balance sheet, right? The balance sheet is going to have assets, liabilities, right? Stockholders' equity, which is common stocks and retained earnings. Okay. All right. So summaries. So take a look at this. If you guys should pause and take a look at this real quick. Summaries of debits and credit rules, right? So the debit and credit rules and effect of each type of the account. Study the diagram carefully. It will help you understand the fundamental of double entry system. So no matter what the transaction, total debit must equal total credit in order to keep the accounting equation in balance. Okay, everybody, thank you.